Can you imagine giving up 60p of every pound that you earned? Or how about that you might actually be better off earning £99,000 instead of £135,000? The unfortunate reality is that this is the case for many people in the UK, which is pretty wild. So let's break down why this is the case and ultimately how you can avoid this 60% tax trap that is so painful. Now, many of you might be thinking, Tom, what are you on about? The top rate of tax is 45%. So what are you talking about with a 60% tax rate? But the specific situation here is when an individual earns over £100,000, because what that means is the second that your earnings trip over that limit, you start to lose something called your personal allowance. Now, your personal allowance is the starting amount of money that you are allowed to earn totally tax-free. It's everybody's right in the UK to this chunk, except for those that are deemed higher earners. And so for every £2 that you earn over £100,000, you lose £1 of your personal allowance. And so what that means is what was previously a reserved amount of money that paid no tax at all, it starts to pay 20%. And in addition to that chunk of money that you're earning over £100,000, which is charged at 40%, it means that combining those two things, you're actually paying 60p of every pound that you earn up to about £125,000 to the government, and you're keeping just 40p of that. And you might think that that's bad enough by itself, but for young parents, it's actually even more painful than this, because as soon as one person in that relationship earns one penny over £100,000, you lose your right to your free childcare funded hours that the government pays you. And this is particularly for someone that has a 3 or a 4-year-old, where as a parent, you get up to 30 hours per week of funded childcare. Now, if we consider what the equivalent cost of that might be to somebody, depending on where you are in the country, you're looking at about £11,000 worth of childcare that would otherwise cost you. And that's the kind of net amount that you would need to pay out of your bank account. If we think about what it actually takes to earn that as a salary, so before income tax and national insurance contributions are deducted, we're talking double that amount in salary that you would need to actually earn to be able to pay those childcare hours. Now, you can pretty much argue this is one of the most painful tax situations to be in. And many people would say, hey, if you're earning £100,000, it means you're making lots of money, so I can't cry too much about that. But ultimately, giving away more than half of the income that you're earning is incredibly painful. So it's vital that we think about what planning opportunities there are here to potentially retain that funded childcare or that personal allowance. And there are no two ways about it. The most powerful tool that you have available to you here is pension contributions. Now, the reason for this being, HMRC consider your total income to be basically earnings minus the amount that you pay into pensions. And so therefore, if you find yourself in a scenario where, say, your total earnings are coming in at around about £120,000, if you have £20,000 available to pay into pensions, what you could do is pay that into either your workplace or your private pension, and HMRC would then complete the calculation of, okay, there are earnings here of £120,000, they've paid £20,000 into pensions, therefore their net earnings are £100,000. And therefore you keep all of your personal allowance and you keep your right to those funded childcare hours as well. And it's quite a difficult situation to be in, because many individuals that I've worked with in the past, if I compare two couples, one might be a very high earner and one might be a non-working spouse. And maybe that's someone with an earnings of £160,000 and the other person with nothing. It's a considerable difference to two individuals that might be earning, say, £90,000 because of all the additional personal allowance and government help that might be available to those individuals. And I get it. This is quite difficult to plan through because there are so many other considerations when paying into pensions. Do we need access to that money? What if we've got a big kind of short-term goal that we need to save for? It might be a bit nerve-wracking to tie up that extra sum into pensions. And this is exactly where financial advice and having a plan comes in for you. Ultimately, you can start to weigh up those decisions and understand what the right next step is specifically for you.